Hello and welcome to the Saturday special episode of the Daily Brief, which we call as the Weekly Brief. As I mentioned last week as well, we are currently working on revamping the Weekly Brief show and we'll hopefully come back next week with some new concepts. But until then, here's a quick summary of some of our favorite stories from the past week. I hope you enjoy. I'll talk about a mega trading scam yet again. Look, in recent times, the rise in investment and trading scams in India has been alarming. People have been losing thousands and crores of rupees to these scams. Just in the last couple of months, scams worth 10,000 crore rupees have been exposed in just one state of Assam. All of these are just the ones that have been reported, by the way. Imagine how many more there might be out there which are unreported and unknown. One of the bigger scams going around nowadays is illegal forex trading platforms. According to the Economic Times, the Enforcement and Directorate or ED recently banned dozens of scammy forex trading platforms that were involved in money laundering. This scam was worth over 10,000 crore rupees. But this is not the first time ED has busted a forex trading scam. This year itself, they have already taken down several scams across the country. But what is most shocking here is how these fraudsters operate. They just don't set up shady forex websites, they build entire fake ecosystems. I'm talking about fake e-commerce websites, scammy forex platforms, and illegal payment aggregators as well. And this is all just not a local operation. These scams have also links to international networks in places like Spain, Dubai, Russia, and Pakistan, etc. So the big question here is, how did these scams go undetected and unnoticed for so long? Look, the answer lies in how sneaky these scammers are. They don't just put together a few fake websites, they instead create entire networks of shell companies. They open multiple bank accounts under fake names and even hire ex-bank officials to help them launder money. Some of these platforms open new bank accounts and change their UPI IDs regularly in order to keep the money flowing, even if one of the accounts get flagged or blocked. Take OctaFX for instance. This platform has been at the center of many scams and they have even hired Bollywood stars and famous cricketers to endorse their products. I'll tell you how these scams exactly work out. See, the scammers first set up unregulated trading platforms that manipulate trading conditions. They usually do this by showcasing fake and profitable trades to attract more investors. They then make it nearly impossible for users to withdraw their funds. Some of these platforms operate like Ponzi schemes. They pay returns to old investors with the money that new investors put in. Eventually, the entire system crashes and everyone loses money. Another dirty trick scammers use is routing money through fake forex trading sites to make illegal funds look legitimate. The ED also found out that money from investors who thought they were trading in forex was actually being directed into SEBI-registered AIFs or alternate investment funds in order to give these funds a clean and legal appearance. The Reserve Bank of India has repeatedly warned people about these platforms and they have mentioned that anyone getting caught trading on them could face some serious action. But despite all of that, these platforms still survive and continue scamming lakhs and crores of Indians every day. It does not even end here. The scammers have also figured out how to exploit the digital payment ecosystem. They use illegal payment aggregators to route funds. This way, they end up creating layers of transactions which make it almost impossible for law enforcement to trace back the original source of the money. With so many platforms still out there, what the ED has found so far is probably just the small tip of the iceberg. But the key takeaway for all of us here is, if you are thinking of trading in Forex or any other online investments, please do your homework. Make sure the platform is registered with the RBI and be careful of any promises of sky-high returns. Always be careful about where you are putting your money. Since the last time we discussed crude oil prices, things have changed quite a bit, and it might be for the better. Considering the fact that India imports 90% of its oil, this is something we really need to pay attention to. As of the time of this recording, WTI crude is trading at around $68 a barrel, and Brent crude is trading at about $71. To give you some context, WTI is the main benchmark for oil produced in the US. Brent, on the other hand, was originally referred to the oil from the North Sea, but today it's used as a global benchmark for light sweet crude oil. Now, the difference between these two is known as the Brent WTI spread. This spread can change based on various factors like supply-demand dynamics, geopolitical events, and transportation costs. Usually, Brent trades at a premium to WTI because of its global reach and better access to shipping routes. Now back to crude prices, the current prices are a huge fall from earlier this year when Brent was trading at around 90 US dollars. But what is causing crude prices to tumble, you might be wondering? Look, first, there are serious worries about global demand, especially from China. The world's second largest economy has been seriously struggling to keep up its growth, which is putting a lot of pressure on oil consumption. Recently, Trafigura, which is one of the world's largest commodity trading firms, said that crude prices could soon go down as much as $60 a barrel. At the same time, the co-founder of Gunvor, which is another big player in the commodities trading space, mentioned that oil's fair value should be around 70 US dollars given the current demand and supply situation. Now, adding to the bearish sentiment, the market is currently facing an oversupply situation. Even though OPEC Plus recently decided to delay their planned output hikes, there is still a lot of oil floating around in the market. Historically, though, OPEC has cut production whenever oil prices dipped below $75 in order to keep prices afloat. But the current market dynamics seem to be very tricky as compared to what it is usually. What makes things even more complicated now is the expected rise in non-OPEC production. Countries like the US, Canada, Guyana, and Brazil are all set to increase production next year, which could flood the market even further. Now, it's not just the traders who are feeling bearish. Big banks are also lowering their forecasts. To give you an instance, Morgan Stanley recently cut its oil price outlook due to worsening market concerns. They now expect oil to average around $75 a barrel. For other context, earlier this year they expected oil prices to be 85 US dollars. Interestingly though, Goldman Sachs here highlighted a very interesting angle, which is artificial intelligence. They think that AI could reduce costs in the oil industry by streamlining logistics and resource allocation. They think that streamlining could eventually lead to increased supply and lower prices. Now, this is an optimistic view, and only time will tell if it actually ends up playing out. Now, I'm sure after listening to all this long yarn, you might be wondering if it really means anything for you sitting in India. Look, the answer is it definitely does. I'll explain. For starters, lower oil prices are generally good news for India's trade balance. As one of the world's largest oil importers, India's import bill is heavily influenced by crude prices. For context, the price of oil in the Indian crude basket has dropped from 84 US dollars a barrel in July to 75 US dollars at the time of this recording. This could help India save billions on its import bill, narrow the trade deficit, and possibly even support the rupee currency. For oil companies, lower crude prices are a bit of a mixed bag. It is great for oil marketing companies like HPCL and BPCL since lower input costs could boost their profit margins. This is already very reflective in the stock market. While the Nifty 50 is up about 15% year to date, the Nifty Oil and Gas Index has jumped 34%. Lower oil prices also benefit companies heavily reliant on crude oil such as paint manufacturers, airlines, and pharma companies. But on the other hand, lower crude prices are not too great for exploration and production companies like Oil India and ONGC. This is because lower prices can squeeze their profit margins and make life really hard for them. A few key events and data releases like the OPEC and IEA's monthly reports and also China's trade data could heavily influence the oil markets in the coming few days. It'll be a great and interesting industry to keep an eye on. Let me talk about how big the front-running problem is in the Indian stock market. Look, recently the Enforcement Directorate or ED registered a case under the Foreign Exchange Management Act against Viresh Joshi, who's the former dealer at Axis Mutual Fund. The ED is conducting searches at premises linked to Joshi in a connection with the Forex violation case. If you followed the news, you would remember that Joshi was caught by SEBI in a front-running probe. But before I get into the details, let me first break down what exactly a front running actually means. Look, front running is an illegal practice where someone with inside knowledge of a large pending transaction uses that information in order to make trades for their own benefits. In the case of a mutual fund, it typically involves a fund manager or a dealer buying or selling stocks just before their fund makes a large trade. This eventually makes them profit from the price movement that is caused by the fund's action. Now, the Axis Mutual Fund case is a very good example of how damaging front running can actually be. SEBI's investigation found that Viresh Joshi, along with some others, had allegedly been front running trades of Axis Mutual Fund for many months. They used a network of accounts to execute trades based on non-public information about Axis Mutual Fund's upcoming large orders. This scheme reportedly generated over 30 crore rupees in illegal profits. Now, the problem is that the impact of such actions is not just monetary. It also ruins investors' trust in mutual funds, which in a manner of speaking, are supposed to be managed by professionals acting in the best interest of their clients. If and when mutual fund employees abuse their position for personal gain, it undermines the entire system. But the Axis case is not an isolated incident. Just last week, the Wall Street Journal reported a whistleblower complaint saying that Bank of America's Asia division engaged in very similar practices. According to the WSJ or Wall Street Journal, the complaint claims that bankers in BofA's Mumbai office shared non-public information with investors before the bank sold hundreds of millions of dollars of stock. Now, this allegedly allowed certain investors to potentially front-run these large trades. The WSJ report specifically mentions two transactions where this front-running occurred. One involved a $200 million sale of stock for a subsidiary of Indian conglomerate Aditya Birla and financial firm Sun Life. The other one was roughly a $500 million initial public offering for SoftBank-backed retailer First Cry. Now, these allegations, if they are proven true, would represent a serious breach of market integrity. These recent cases are part of a larger worrying trend. Over the past few years, we have seen front-running allegations surface against several major players in India's financial markets. Back in 2022, the Life Insurance Corporation of India, or LIC, faced some scrutiny when SEBI issued an order against 5 entities involved in a front-running scheme related to LIC's trades. The regulator found out that these entities had made gains amounting to 2.44 crore rupees through their front-running activities. As a more recent example, Quant Mutual Fund had come under investigation and SEBI conducted search and seizure operations at their offices in Mumbai and Hyderabad. SEBI's own data confirms the growing scale of this problem. According to their latest annual report, the number of insider trading investigations taken up by the regulator more than doubled from 85 in 22-23 to 175 in 2023-2024. What is even more surprising is the surge in front-running cases, which jumped from 24 to 83 in this same period of time, which is an increase of over 245%. Now, the frequency and scale of these cases have prompted SEBI to take some serious action. The regulator has proposed expanding the list of connected persons in its insider trading regulations. This would broaden the scope of individuals who could be held accountable for such violations. In a consultation paper released in July, SEBI outlined its plans to widen the net of who's considered a connected person. These proposed changes would include more family members, business associates, and individuals with close financial ties to those already connected. This is to capture those who might have access to insider information through their relationships, even if they do not have direct connections to the company. SEBI's new proposal also looks to align the definition of a relative with the broader one that is used in the Income Tax Act. This will potentially bring more family members under scrutiny in these cases. The regulator's larger goal here is to close all loopholes and make it very hard for insider information to be misused ever again. This proposal, however, has faced some serious criticism. Sandeep Parekh, who is a very noted securities lawyer, argued that the expanded definition could potentially criminalize innocent individuals as well. In an article, Parekh warned that the proposed changes might lead to a situation with 100% false positives and 100% false negatives. This means it could implicate innocent people while still failing to catch the actual wrongdoers. Now, Parekh's concerns are very fair and they highlight a very delicate balance that regulators need to strike here. On one hand, there is a very clear need to crack down on front-running and other forms of market abuse. But on the other hand, overly broad regulations risk creating unintended consequences and potentially shifting legitimate market activity. In response to all these concerns, the Association of Mutual Funds in India, or AMFI, recently unveiled new standards to prevent front-running and market abuse at asset management companies. AMFI's new framework includes stricter surveillance measures, enhanced alert systems, and tighter controls on personal transactions of key employees. Now, these standards will be implemented in phases. It will start with large equity funds in November 2024 and will gradually expand to cover all types of funds by August 2025. These measures aim to create a more robust system for detecting and preventing market abuse, thereby enhancing investor protection and market integrity. Now, while these steps are definitely great, their effectiveness will definitely depend on implementation by fund houses and the ongoing oversight from regulators. Let's talk about how India's consumption story is changing. See, 10 years ago, the typical Indian meal looked very different from what we see today. Back then, cereals dominated and took up a significant portion of both the plate and the household budget. Fast forward to today, we are witnessing a remarkable transformation in what India eats. For the first time in modern India's history, families are spending less than half their income on food. And this is not because we are eating less. In fact, we are far from that. This is a sign of economic progress, with rural food expenditure increasing by 164% and urban by 146% in the past decade. The share of cereals in food expenditure has plummeted from about 10.7 to 4.9% in rural areas and from 6.6% to 3.6% in urban areas. But this dramatic drop does not necessarily mean that Indians are eating fewer cereals. A significant factor behind this decline is the impact of government food security schemes. Programs like the Public Distribution System or PDS have been providing free and subsidized grains to millions of low income households. This has substantially reduced out of pocket expenditure on cereals, particularly for the poorest families. For instance, the bottom 20% of households have seen the most substantial decrease in cereal expenditure today. In rural areas, it has dropped from 22% to 14.5% of their food budget. This reduction in cereal costs has freed up household budgets to diversify their diets. We're seeing fruits, vegetables, milks, eggs, and meat making their way into Indian plates across the country. For families in the bottom 20% of the income bracket, fresh fruit consumption has increased substantially. Milk, which once used to be a luxury for many, has now become more common. This shift has demonstrated how government food security policies, along with rising incomes, are not just ensuring basic nutrition but are also enabling diverse diets. Now, improved infrastructure has also played a big role in these changes. Better roads, better storage facilities, and transportation systems have made fresh food available all year round, even in the most remote corners of the country. The concept of seasonal eating is also becoming a thing of the past. Now, this dietary diversification is not just changing what is on the plate, it is also improving health outcomes. Increased dietary diversity is associated with 14% lower prevalence of anemia in children and women. But this nutritional transition does not come without any challenges. As traditional staples are giving way to more varied diets, we are seeing a drop in cereal consumption across all groups. While this makes room for more nutrient dense foods, it also requires rethinking of agricultural policies that have long focused on cereal production in India. Also, the rise of modern lifestyles has brought new problems. Consumption of packaged and processed foods, which is often high in sugar, salt, and unhealthy fats, is rising quite fast, particularly in urban areas of the country. At the same time, there has been a slight drop in vegetable consumption. Even more concerning is the increase in spending on tobacco and alcohol. The share of household expenditure on pan, tobacco, and intoxicants has risen in rural areas. To put this into some perspective, a typical rural household in 2022-23 spent more on these items than on fresh fruits. It is similar in urban areas as well. On one hand, we see positive shifts towards more diverse and nutritious diets, particularly among lower income groups. But on the other hand, there is a rise in consumption of processed foods, alcohol, and tobacco, which brings a big point of concern. Now, all of these changes that we're seeing on India's plates have big implications. They are reshaping agriculture, influencing public health policies, and reflecting broader economic shifts. While our nation continues to grow and evolve, so does its relationship with food. This decade of change tells a story of progress. Diets have become more varied and nutritious across all sections of society, but it also highlights new challenges that require innovative and new solutions. From policymakers to farmers, from food manufacturers to consumers, everyone has a big role to play in shaping the future of India's food landscape. Now, moving on to the next story, let me talk about the Adani Group. Now, I have two interesting stories about it. The first story takes us to Kenya, where Adani Group's plans to acquire and operate Nairobi's main airport has hit a big speed bump this week. Look, on Tuesday, hundreds of workers at Kenya's main international airport went on strike to protest the proposed 30-year lease deal between the Kenya government and the Adani Group. The strike has caused major disruptions, with delayed flight and stranded passengers. Now, at the heart of this issue is a $1.8 billion investment offer from Adani to lease and operate this particular airport. Now, this deal would give Adani control over Kenya's busiest airport and also a key regional hub. However, aviation workers and unions are concerned about potential job losses and a foreign control of a strategic national asset. There are also questions being raised about the transparency of the bidding process in the first place. Now, by Wednesday evening, this strike had ended after the government gave assurance to workers that they would have veto power over any final agreement. But this episode very clearly illustrates the challenges that Adani today faces as it is pursuing its ambitious international expansion plans. Now, Adani has very rapidly grown its airport portfolio in the very recent years. It now operates 7 major airports in India, and this push into Kenya shows Adani's desire to become a global player in airport management. But as we've seen, entering new markets is not always very smooth. Now let's look at the second story, which is Adani's massive new port projects. Now this one requires some more context, so do bear with me please. Now, India has over 200 ports along its 7,500-kilometer coastline. This handles about 1.5 billion tons of cargo every single year. But the catch here is India's port capacity utilization is only at about 60%, and most ports cannot handle the world's largest ships due to depth limitations. Now, this is where Virineum, Adani's ambitious deep water port project in Kerala, comes to the picture. See, this is located near India's southern tip, and the port is perfectly positioned to capture traffic from lucrative international shipping routes. But why does this port matter, you might be wondering? Look, it's all about location, depth, and competition with Sri Lanka's Colombo port. Currently, about 75% of India's transshipped cargo is handled at port outside the country. Of this, Colombo, Singapore, and Malaysia handle more than 85%, and Colombo port alone handles 45% of this cargo. Now, this is because many Indian ports are not deep enough to accommodate mega container ships. If this cargo were to be handled in India itself, we could save as much as 1,500 to 2,000 crore rupees every single year. But over here, let me take a small pause and explain to you what transshipment means, because it is key to understanding why this port is actually such a big deal. Now think of it this way, massive container ships, and I'm talking about vessels the size of several football fields, carry goods across the world's oceans. But these ships are so big that they can only dock at a handful of ports which are deep enough to handle them. And that is where transshipment comes in. Now these huge ships stop at deep ports like Colombo or Singapore and offload their cargo to smaller ships who pick it up and distribute it to other ports in the similar region. Now Virineum specifically has a natural depth of 20 to 24 meters, which means it can accommodate the world's largest vessels. Now this can help India really recapitulate billions in economic activity that is currently going to Colombo instead. Now interestingly, the Adani Group is not just challenging Colombo, they are also investing there. In 2021, the Adani Group signed a deal to develop and run the Western Container Terminal at the port of Colombo. This is a $700 million project where Adani holds a 51% stake, which aims to add more capacity to Colombo's port. Now, this dual strategy of developing Virineum port on one side and investing in Colombo on the other side shows how Adani's ambition to dominate regional shipping is crazy. Now, back to Virineum, the project has seen many delays and controversies ever since Adani won the contract back in 2015. But things are now finally moving forward. In June this year, Virineum welcomed its first commercial vessel. Now, this milestone marked the beginning of operations at India's first custom-built transshipment port. Now, the momentum is building very rapidly. As of September, trial operations at Virineum are in full swing, and this shows the port's growing importance in global maritime trade. The port has already hosted multiple large vessels, including ships with draft up to 16.5 meters, which is some of the deepest ever recorded for ships docking at Indian ports. Now, if you think about it, it is a game changer for India. Virineum's natural depth of about 18 to 20 meters allows it to accommodate the world's largest container ships without extensive dredging. And this depth advantage, along with its proximity to major international shipping routes, means that Virineum can become a major hub in global transshipment very, very soon. The world's largest shipping lines are taking notice, by the way. Mediterranean Shipping Company, which is the global leader in container shipping, has already sent 5 ships to Virineum during these trial operations. There are even reports of ongoing discussions between MSC and Adani about the shipping giant becoming an anchor customer for the port. Adani Port is now planning to invest $1.2 billion to boost Virineum's capacity, and they're aiming for an eventual annual capacity of 6.2 million TEUs. Talking about Adani Ports in specific, it has become India's largest private port player and it now handles about 27% of India's total cargo and a massive 46% of the country's container traffic. And that is a remarkable rise from just 14% market share in FY 2015. Adani has gone from operating just 2 ports in 2011 to 14 ports today. And remember, ports are a very capital heavy business. Now remember how I had mentioned Adani's investment in Colombo ports? Let me explain that a little bit to you. In November 2023, the US International Development Finance Corporation or DFC announced a $553 million loan to Colombo West International Terminal. This is a joint venture where Adani holds a 51% stake with the rest owned by local partners and the Sri Lankan government. Now you might be wondering, why is this American involvement so significant? Look, it's not just about financing a port. This move is also widely seen as a strategic counter to China's growing influence in this region. Let me step back and help you look at the bigger picture. China has been heavily investing in ports across the Indian Ocean as a part of its Belt and Road Initiative. According to a 2021 study by Gateway House, China has varying degrees of involvement in at least 17 ports in the Indian Ocean region. This includes a significant investment in Sri Lanka itself. For instance, China operates the Colombo International Container Terminal with 85% stake. Even more famously, it also holds a 99-year lease on the Hambantota port, which Sri Lanka handed over when it could not repay Chinese loans. So when the US steps in to fund an Adani project in Colombo, it is not just about supporting infrastructure development. It is also a clear signal of America's intent to counter China's maritime expansion in this strategically crucial region. For Adani specifically, this US backing is very significant on multiple levels. First, it provides crucial funding for the $700 million terminal project. But perhaps more importantly, it is also a vote of confidence from the US government in Adani's ability to deliver on a large scale. Now, the timing of this could not be better for India. With Colombo facing congestion issues due to the Red Sea crisis and geopolitical uncertainty, Virinium has an opportunity to establish itself as a major regional hub. If Virinium can attract major carriers and prove its efficiency, it could significantly alter trade flows in the Indian Ocean region. As these projects progress, it will be very fascinating to see how they impact regional trade patterns and whether or not they can succeed in providing an alternative to Chinese-backed port infrastructure in the Indian Ocean region. That's all the news and stories I have for you today. I hope you found value in this episode. I'll see you tomorrow. Take care and goodbye.